we're almost at record deficits again if you include silver flowing into silver ETFs. So that shows you again the market is very tight, and we've started to see that happen. Right here in July of 2024, silver flows into SLV, which is the world's largest silver ETF. We've seen silver start to flow back into that ETF in a big way. I think they're starting to see it as a strategic and a critical metal, and they're playing their cards close to their chest, and they don't want to get caught off guard. So this is a chart that shows the price of silver adjusted for inflation. It peaked at adjusted $145. It gives you some potential for where silver might go eventually.
The silver market is currently facing a unique convergence of factors that could lead to a significant surge in prices, according to Peter Krauth, author of The Great Silver Bull. Speaking at the Vancouver Resource Investment Conference, Krauth shared his insights into silver's recent performance and what investors should anticipate in the coming year. He pointed out that 2024 had been a strong year for silver, with prices climbing from a low of $22 per ounce to a peak of $35. This substantial increase suggests that the market is gaining momentum, fueled by a combination of industrial demand, investment interest, and supply-side challenges. Krauth noted that such a price movement in a single year highlights silver's volatility and potential for dramatic swings when market conditions align. One of the major factors influencing silver prices is the profitability of mining companies, which has long been dependent on the price per ounce. Krauth explained that miners have struggled with thin margins when silver traded closer to $22, as the cost of extraction, refining, and operations often came dangerously close to selling prices. The recent rise to $30 per ounce has provided some relief, making operations more sustainable. However, he stressed that for many mining companies, current prices are still not high enough to guarantee strong financial stability. He emphasized that the costs associated with acquiring and developing mining assets, which include exploration, permitting, and infrastructure development, often push the total all-in costs beyond $30 per ounce. A critical issue that Krauth highlighted is the growing supply deficit in the silver market. He pointed out that global silver production peaked in 2016, and since then, there has been no meaningful increase in mine supply. This stagnation in output comes at a time when industrial demand for silver is surging, particularly due to its crucial role in the solar energy sector. Traditionally, industrial applications accounted for about 50% of total silver demand, but that number has recently increased to around 60%. This shift is largely driven by the rapid expansion of solar technology, where silver is a key component in photovoltaic cells. Krauth described the growth of solar demand as almost exponential in recent years, with solar energy alone now making up about 20% of total silver consumption. This rising demand, combined with constrained supply, is tightening the market and adding upward pressure on prices. Now, let's take a look at Kathy's insights from her recent interview. Before we continue, please subscribe to our channel and activate the bell icon to stay updated with our latest content.
Moving on to sort of the fundamentals, I think we're going to continue to see big deficits continue in the silver market. This is some research by Bank of America Global Research, and they looked out 10 years from 2020 and at all the base metals, and including platinum and silver in addition. And by far, silver was the metal that they forecast that would have the largest deficit. And so it's not that obvious because it's a pretty big scale, but that bar, that down bar on the very right, is actually 120%. So they figured that by 2030, the silver market would actually be in 120% deficit. So I don't know how that can actually be mathematically, but it certainly bodes well for higher silver. And very recently, there was some research that came out by TD, and they entitled this piece "Sleepwalking Towards a Silver Squeeze." And really, the gist of it is what they're saying is that the exchange for futures versus physical, the premiums on the exchange to get physical right now versus the futures price are abnormally high, and that this implies that the market participants are looking to take delivery immediately of their silver of physical metal versus having to hold the futures contracts, and this is being driven by the threat of tariffs in large part by Trump. So this morning was his inauguration. There was again some talk of tariffs. I've heard that he's sort of dialed that down a little bit, but that certainly is not resolved, and I'm sure he'll be willing to pull that out any time it's in his favor. So to kind of sum that argument up, really what they're saying at TD is that metal is flowing from London to the U.S. on Trump tariff fears, and just 30% of London silver is really available for delivery. So these are getting really tight in terms of markets. This is a chart that shows the LBMA inventories, the London inventories. They're at near historical lows, or I should say near decade lows, very much long-term lows. Just December had a 23 million ounce drawdown again. And as you can see, that's near the lows of the decade. Just to break down the inventories a little bit in London, we're talking about a total of about 825 million ounces. Of that, about 525 is committed to silver ETFs. London is the place where silver ETFs, for the most part, choose to store their silver. So that leaves a free float of just 300 million. About 250 million is required for daily trading. And so you really have a buffer, a historically low buffer of just about 50 million silver ounces. Similar thing is happening in New York on the COMEX. Only 23% of their 300 million ounces are what we call registered. So that means just 70 million ounces are actually available out of the 300 million ounces for actual physical delivery. So although it's a little bit counterintuitive, we've seen the inventories in New York spike up. But if you think about what I was saying earlier, how they were trying to front run the risk of these tariffs. So if they would have had to import their silver from London or somewhere outside of the U.S. into the U.S. and the tariffs were put into place, they'd be at risk of having to pay those tariffs on the metal. So they were trying to get ahead of that. And so that's why I think we're seeing that spike in the inventories there. At the same time, participants are taking delivery. So it's one thing for them to have a claim on the silver at the COMEX. They're more comfortable in having direct control over it. So we've seen a spike in deliveries from the COMEX of the physical. We've seen a similar bit of activity in Shanghai in terms of inventories. I think similar reaction there, risk of threats. The premiums in Shanghai, they've been higher, but they've actually just spiked. If you see on the very right, they've spiked again. They're paying almost 10% above New York prices. In India, it's a little bit different in terms of what's driving that, but they've turned to silver in a big way. I think they've found gold has become very expensive for them. I'm being told anecdotally that they're turning to, although they love gold, they're buying silver, and now they're buying gold-plated silver. So they're getting the gold look, but they're actually paying mostly for the silver. And so a lot of money they've started to develop their own silver ETFs. There's about $40 million a month since early 2022 that's flowing into silver ETFs in India. And in India, their premiums are being driven probably a little bit by different drivers, more so by the debasement of the rupee, but they're at 20% over New York prices for silver. And this is in the short-term contracts. The futures over futures to spot spread popped in January. I think there was some news then about tariffs again on that day, and they jumped 50%. So it's a small premium, but it jumped by 50% in that same day. And if you look at the long-dated contracts, they're $5.50 over spot price. That's the highest we've ever seen. It's higher even than when silver was at $50, and again, that's the market signaling that they expect silver prices if you look farther out.
Beyond supply and demand fundamentals, another key factor shaping the silver market is merger and acquisition, M&A activity among mining companies. Krauth believes that consolidation will continue as larger producers seek ways to replenish their reserves. Many mining companies face declining ore grades and depleting reserves, forcing them to look at acquisitions as a strategy to secure future supply. Krauth expects that in the near term, larger producers will initially target smaller mid-tier mining firms before expanding their interest to developers. This M&A trend could significantly impact the silver market by altering production capacity, reshuffling market dynamics, and potentially leading to greater efficiency in supply chains. For investors, these corporate moves could signal opportunities to gain exposure to silver through companies positioned for growth via acquisitions. Investment demand remains one of the biggest wildcards in determining silver's future price trajectory. While industrial demand provides a strong underlying foundation, investment demand is what drives dramatic price movements. Krauth explained that when investor enthusiasm surges, the available supply of silver quickly tightens, leading to sharp price increases. One clear indication of growing investment interest is the rising number of ounces held by the largest silver exchange-traded fund, ETF, SLV. The increasing flow of funds into silver-backed ETFs suggests that investors are once again turning their attention to the metal, possibly as a hedge against economic uncertainty or inflation. Krauth noted that when this type of investment demand gains traction, the effects on price can be swift and significant, as was seen during the silver squeeze movement in early 2021.
Global debt, and this is at the beginning of 2024, it was at $315 trillion. Obviously, a record. I can't even imagine, how much higher we are now after another year of this kind of action. But that's certainly the kind of setup that Minsky's talking about. The global money supply, that actually, as we can see, that popped in the wake of COVID and then drew back down. Central banks, when they saw inflation, started to raise rates and all the stimulus started to dial back a little bit. And we had a couple of years of sideways movement, and now we've seen that really start to pick up again. So just last year, we saw $7.3 trillion of new money coming into the world. And this is starting to trickle down into the main street, the average investor's minds, and really it's signaling a shift in the bond markets and inflation and the perception of the likeliness of inflation sticking around. And so if you look at what happened, just one of the last times that this happened, in August of 2023, you had this spike in the 10-year yields. The S&P was down by 10%. So really, higher yields, as you can imagine, they compete with stocks. There's opportunity cost. People will ask themselves, why do I need to take risk in stocks when I can be in bonds, sovereign bonds? We don't need to argue about the security of sovereign bonds, but at least if it's in relatively short term and yields are spiking, and there's certainly an argument to be made for bonds versus stocks. Now, talking about inflation and parallels with the 1970s, so this chart, there are different scales on the two sides. One is the 70s and the other is the 2020s. But this lays the two periods, one over the other, and it's incredible how much they've followed. So this current wave of when in July of 2022, we peaked at 9% inflation, that was similar to the second wave, which was in the mid-1970s. And the interesting part is that, as you can see, we're getting close to potential bottom now. And I've been saying for a couple of quarters that we're very likely to see a bottom, I think, sometime this year, and the inflation is going to start to creep up again. So if you think you're not happy with inflation now, enjoy what you've got, because I think it's going to get worse. The average person is really starting to accept, I think, that inflation is here, it's baked in, and it's going to continue.
Looking ahead, Krauth believes that current market conditions are setting the stage for a potential surge in silver prices, particularly if investment demand accelerates. While he does not anticipate a full-blown mania phase in which prices skyrocket into the triple digits this year, he does see the potential for another significant rally. If industrial demand continues to rise, supply remains constrained, and investors increasingly turn to silver as a safe haven asset, the metal could see another year of strong price gains. With growing interest from both industry and investors, silver appears to be on the verge of another major breakout, positioning it as a compelling asset for those looking to capitalize on market shifts. If you found this message compelling and enjoyed the video, be sure to give it a thumbs up, share it with others, subscribe to our channel, and turn on post notifications for more thought-provoking content. Thanks for watching.